Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com.
Welcome to another episode of Dancing with the PIIGS. A lot of news out of Europe every day, it seems, right? The EU summit, what did that tell us, right? More fiscal integration, but was that a short-term solution that will stop the bleeding? Or is this something that's going to drag on for months? We even have Mario Monti of Italy saying that the ECB should issue Eurobonds. On top of this, what do the rating agencies think? S&P and Moody's are both out saying these are just incremental steps, and longer term, Europe is still in deep water. All right, here to separate the substance from the headlines. Some beautiful guys, not PIIGS.
Not PIIGS.
Steve, what did the EU summit give us anything, or was this just Germany remaking the Eurozone? And why did we rally 20 points on Friday only to give it back today in the S&P?
Yeah. For me, what I think it is that most of the nations are staying together. Okay, so the UK kind of said, no, I'll take a pass on that, but they've been taking a pass on things for a while. Right. I think they're incremental steps. They're still valuable incremental steps, but the thing is, at each juncture, they have a chance to pull apart, okay? But they keep sticking together. And for me, that is a resolve that I need to see, that if things do not get better, they will go another round and find, whether that be Eurobonds or whatever it is, that they will keep sticking together and they will keep finding ways to make it work. Right. And so that was good enough for me.
Okay, so in the short term, though, do downgrades to debt from S&P and Moody's, is that going to put more dark clouds over this thing?
The bond investors are already ahead of S&P and Moody's. So
that's true.
Take a look at the rates. So they're not too happy with it. So the bond rating changes don't make that much of a difference. If Germany gets a reduction, that's a different issue.
Right. But if everybody gets downgraded at the same time, everybody's position stays the same. So what?
And maybe the British pound goes higher.
Yeah.
Shiraz, is austerity going to kill growth more than is being forecast right now? So, for instance, we're looking at a mild recession for Europe. Are the real austerity measures that are going to come forth in the next year, are we looking at multiple quarters of negative GDP for Europe?
That's a real possibility. It's very difficult to handicap the extent of negative growth that EU and the Eurozone in particular will go through in 2012, maybe even 2013. So yes, it's possible. But let me just quickly latch on to the comment that Steve made. I agree that what they came out with on Friday shows enough commitment on the part of these major European countries to stand behind the project. The project being the Euro project, the monetary union, and them moving towards a fiscal union. And the expectation was that this gives enough of a cover to the ECB to start playing the role that the Fed's been playing here in the U.S.
Right. Well, they might be doing some stealth QE here because they created this lending facility for 3 years out to commercial banks. Right. Commercial banks can now borrow it next to nothing from the ECB, right. Turn around and buy the high-yielding debt of Italy or whoever. But is that sustainable?
That's what the thing we need to see now. We need to see if the Italian bond yields go back above 7%, 7.5%. Is Draghi going to just sit back and keep making those modest purchases as he was doing prior to Friday? Right. So the expectation now would be that the ECB comes out in full force and backstops that uptrend that we had been seeing in the Italian and Spanish bond yields.
All right, Kev, last word here on Europe.
Yeah, they more than doubled the financial safety net with that 500 billion euro EMS, right? They also authorized more than $200 billion loan to the IMF. And the real benefit here is that the specter of a 50% haircut was taken off the table. So bond investors don't need as much of a risk premium to be able to buy sovereign debt. So I think the agreement was good enough. It buys Europe a bit more time.
All right. We'll be back in segment 2 and look at our forecasts and a possible earnings warning season coming up.